Good morning, everyone. This is Daily Trading Analysis with the weekly recap for this week, which has been pretty negative. A lot of information came out, economic data, important information like services PMI, JOLTS, inflation preliminary results, jobless claims, and non-farm payrolls. And all this data came out pretty negative with a surprising upside risk for inflation. All these coupled with the fact that there's a lot of uncertainty with Trump tariffs makes a really low and negative sentiment in this time. I'm evaluating this with 15 and pretty bearish sentiment, and I'm going to cover, as always in this weekly recap, the economic data and also the price action and several sectors that are showing really upside risks like dollar and yields, and also downside potential for indices and also stocks and semiconductors. So we are facing a lot of challenging data. This environment is pretty negative, and this is prevailing among investors and also day traders. This is largely due to a confluence of factors: building inflationary pressures, uncertainty surrounding the Federal Reserve's future policy decisions, and also rising geopolitical tensions, all these adding to the overall market volatility. So there are a few positive aspects. We have a really stable labor market, but there's clearly a big wave of negative influence clearly dominating the market. And this is, at the end of the day, this is pointing towards rising inflation, especially within the services sector. We can see here we have services PMI and prices paid really showing upside pressure. All green means that we are above the forecast and above the previous one. And look at the prices paid, 64 coming from the 58. We are at huge territory. This is negative because higher than expected services sector activity suggests robust economic growth, but also potential inflationary pressures impacting the possibility of rate cuts. Also, the Michigan one-year inflation expectations, we can see here, came out at 3.3%, at a full half percent above the 2.8 forecast and the previous reading of 2.8 also. So 0.5% higher indicates that the consumer inflation expectations are on the rise. All these data points signal a potential challenge ahead for the Feds, and the Fed itself is contributing to market uncertainty. Recent statements from Fed officials had adopted a more hawkish tone, suggesting a potential slowdown in the pace of rate cuts and even the possibility of further hikes. This had led to a shift in market expectations, with traders now fully pricing the next rate cut much later. Look at this. We have 0 rate cuts until at least June. And this is from the Fed Watch tool. But in terms of bonds, we are in October. The market is pricing in really late, if any, rate cuts. So this change in sentiment is significantly impacting market activity. All these factors are creating a very complex and difficult scenario for the US markets to navigate. Adding to this complexity, we have increasing geopolitical tensions. We are not alone worldwide. We have also to see in other parts of the globe how inflation is affecting and how are the tensions in trading. Because in this case, North Korea's recent missiles launches being a stark reminder of the risk involved. Potential economic and trade policies of a new administration is causing, I see, a lot of anxiety Trump's rhetoric regarding tariffs and trade with other countries, including Canada, Mexico, and even Denmark over Greenland, is creating a lot of difficult sentiment for the markets. Also, his remarks contributions on NATO contributions and his unwillingness to rule out economic or military tools for certain nations are also adding to the negative sentiment on the market. So basically, there's a lot of difficult things to navigate here. We had also pretty negative sentiment on the indices overall. We have been in the S&P falling 1.94%, the Nasdaq 2.34%, the Dow Jones dropped 1.80. So this broad decline across major indices indicates a widespread negative sentiment. This is further supported by the increase in the US one-year credit default swaps that I was telling you by 22 basis points, the highest since early November, which signifies increased perceived risk in the US market. Finally, with the private rolls, we are seeing a positive big increase in non-farm payrolls, 223 compared with the 182. This is positive because it means growth, but be careful. Higher inflation and less pressure on the Fed for rate cuts. So this is the summary on the economic side of things. We've been really stressed this week with a lot of, I mean, I think the sentiment is pretty low. 15, I'm going to tell you something. This is exponential to the downside, meaning that to achieve lower sentiment analysis means that we have to really stack up on really negative news. And as you can see, we've reached 15. This is the lowest I've seen since I'm starting to use this tool that I built up from scratch since the start of this year. So 15 is pretty low. So in summary, we have stock market in a really bearish state. We have the direct US data pretty bearish, but also non-US direct economic data is super bearish. Across the globe, we are seeing higher inflation data, higher stress, higher upside risk for inflation, and we are seeing across the globe everything. But we are trading the US market, so the weak global economic data and rising inflation expectations are suggesting increased risk, and this is really big for the negative. The key takeaways are basically the bias towards the downside. We are seeing a lot of pressure, a lot of selling. Big players are really protecting them. And the market vulnerability, it's also around 15 to 16. It's strongly negative. It's really vulnerable. And I think there's a lot of surprises, negative surprises on key economic indicators. So if you were short this week, I think you were pretty semi-open trading view. If you were short this week, really congratulations, because I think you were nailing the trades, because we are seeing a lot of downward pressure. You can see this is the market internals. We have the start of the week, and look at how we ended the week on the volume side. We are seeing a big increase in volume to the downside. And also, look at where are we going the downside in the advanced decliner. This is for the ES, pretty negative. This is dragged down by the financial sector. We are going to see that dragged down by the banks, dragged down by Russell. The Russell was minus 2%. Why? Because the Fed rate cuts are really late, impacting all businesses. If we change the market internals to the Qs, we can see that we started the week trying to go higher, but then Thursday and Friday was pretty hammered down. Look at the advanced decliners. Since the open, we are seeing really traders smacking down. So in terms of market internals, we had that. In terms of, let me show you, in terms of the daily, the NQ, it's continuing its pattern. We have a really clear pattern. If you watch my last weekly recap on Saturday, we can see I was explaining that I was really waiting for the market to push 20,000. I think it's way lower, but due to these surprises to the downside on the economic data, I think it's the market has a justification, a reason to go down in order for some catalyst to really push, and then a lot of investors to grab really discount prices down here. So I'm still waiting for these key zones of liquidity. Overall, I think 20,500s, this pivot might be good, but let me adjust. But I think we have a lot of liquidity at lows 20,000. So don't be surprised if we continue seeing this kind of clear pattern to the downside. We are seeing an orderly pullback, and this is controlled by bear. So if you are looking for longs, be really careful because it's not easy at all. This is the 1 hour. We have a really clear structure with two big fair value gaps on the 1 hour, really controlling the narrative on the 1 hour, this higher time frame, and even on the 15-minute. We are seeing, look at Thursday. Thursday was a nightmare. And then on Friday, we saw a really holding pattern on the overnight, but then when non-farm payrolls, all the economic data came out, really had a really, so last week low was reached, and we are in between this range, and I think we are entering a potential zone on the day for bulls to appear. But look at these pivots. These are really clear zones of liquidity on the sell side that I think the market is at some point. Be really careful on longs. We are seeing this line is the 200 on the daily. Let me show you. We've seen in the past the 200 daily moving average being support. That's exactly right now. Let me show you at 20,200. And I think investors are going to see this really clearly. So be patient. Wait for these key zones to be comfortable if you are looking for long-term longs. If you are looking for short-term scalps or day trading, I think the bears have a lot of control right now on the price action. In terms of other markets, we are seeing a huge push on the dollar. We are seeing a strong dollar, and this is putting a lot of pressure to the downside on the stocks. Also, the 10-year and the 2-year yields are really pushing. Look at Friday. Friday was 2.74 in the green for the 2-year yield. This yield, this short-term yield, is really controlled by the interest rates by the Fed. So this is clearly showing you the panic mode, the fear, the concerns about perhaps some hikes in interest rates. I wouldn't discount that. As I was mentioning earlier, we have the Russell really suffering minus 2.20%. If we check the RSP, we are seeing a clear signal of people fearing out about the small caps. The momentum, the trend, and the long term, daily moving averages are pointing all to the downside, and the RSP, the equal weighted ETF, is really under pressure. And I think we have a clear zone right here. We have a really clear direction to expect the price action, the price to continue moving down. Also, I was mentioning that banks are really struggling. Look at this on Friday, minus 2.41 on the XLF. It's a pretty big deal. And it's really showing you how the market is really pressured right now in all fronts. We have XLF, we have consumer discretionary also in the red, we have staples, we have healthcare. The only thing that was even in the green was that look at this candle. Look at the banks, all in the range of -2 to -3%. Also, semiconductors, 2%, with AMD -4%, Nvidia 3%. And this is great. We have really big volume on Nvidia on 124. It's like 15 points lower, more or less, 10 points lower. It's pretty crazy in all sectors, in all stances of the market. So what I'm expecting for the upcoming weeks, it's sadly a lot of pressure, a lot of volatility, and in higher time frames, a lot of continuation to the downside. So the first key zone that I would like to see is what happens with last week low at 21,000. 21,000, it's one thing I would like to see. It's a very key psychological level. In the 1 hour, we saw this pivot being taken out and then quickly reclaiming that. So I would like to see 21,000 to really hold the price action and then see what happens. We have a lot of things, a lot of inverse fair value gaps that are holding the price action. So we might see a dead cat bounce, who knows? But I will be only watching Monday 21,000. I most probably 100%, 99% I won't be trading on Monday. And I will be watching the price action. How do we start the week? Are we opening range in the week? Are we gapping up the week? How 21,000 holds the price action? How, if any, gap appears, how that holds? I'm going to watch to see how, after the weekend, investors and traders trade the Monday. If there's big volume, how the market internals are there, what happens with the dollar, what happens with crude oil, because crude oil is right now spiking on inflation fears, what happens with Europe also, in the opening, UK, it's also pretty good. It bounced, and we are right in the point of contact. What happens with Japan indices? I will be watching worldwide what is happening during the Monday. I really encourage you to do this kind of thing. Watch price action, how levels affect the price, what gaps appear, how the price react to those gaps, how price move towards levels of liquidity, things like that. And you will be learning a lot on how price moves on Monday. Mondays are really difficult, really dangerous, because after the weekend you can expect everything, and everyone's expecting continuation on this trend. So Monday might surprise, and the first thing that I would like to see how it reacts, it's 21. So I think we have covered a lot of things. The sentiment is pretty bad, and honestly, mm, it's it is what it is. So we have to really be humble. We have to really be flexible on adapting on these circumstances and being on top of economic data. And the market is really sensible right now. really sensitive to any kind of catalyst. And unfortunately, I think good news is again bad news. And I think that's all. Be really careful with this market if you are trying to buy every dip at the proper moment. And remember that discipline, patience, and risk management are key to survive. We have to really survive. If we are bullish overall, we have to really watch the market and analyze how it reacts before jumping on anything. There's a lot of volatility, there's a lot of negative sentiment, and I think the market will show us when it's prepared to move really in a strong manner to the. Until then, be really careful. Stay safe, everyone. Have a nice weekend and see you on Monday.